Do you think investing is only for rich people or stock market experts? If yes, you're not alone. A lot of smart people avoid investing for years because of myths that sound true, but are actually wrong. Over time, these myths make investing feel risky, complicated, and out of reach, even though it doesn't need to be. The truth is, investing is simply a tool that helps money grow when it's used with patience and clarity. In this video, I'm breaking down 5 common investing myths you should ignore. Each myth will be explained clearly, without complicated terms or fear-based thinking. Let's begin with the first myth. 1. You need to be a stock market expert to invest. Many people believe investing is only for professionals who understand charts, financial reports, and complex market terms. This belief makes investing feel confusing, intimidating, and out of reach for everyday people. As a result, many never take the first step because they think they must master everything before they begin. The truth is that investing is a journey that anyone can start, even without deep financial knowledge or experience. You do not need to understand every detail before investing. In fact, learning often becomes easier once you are involved and paying attention. Knowledge builds naturally over time as you become familiar with basic concepts and see how markets behave. Today, there are many simple investment options designed specifically for beginners. These options remove the need to pick individual stocks or spend hours studying market movements. This allows people to participate without feeling overwhelmed. Investing is not about knowing everything from the beginning. It is about starting with a basic understanding and building confidence gradually. Waiting until you feel ready enough often leads to long delays, and during that time, opportunities are missed. This myth causes people to underestimate their ability to learn and adapt. When investing is approached step by step, it becomes much more manageable and far less intimidating. The longer someone waits to begin, the more time they lose for growth to work in their favor. Starting small and learning along the way often leads to better outcomes than waiting for perfect knowledge. Investing rewards patience, consistency, and willingness to learn, not expert-level skill from day one. 2. You need a lot of money to start investing. Many people believe that investing is only meant for those with large bank balances. This belief makes investing feel exclusive and out of reach, especially for beginners who are still managing everyday expenses. As a result, people delay starting because they think their money is not enough to matter. In reality, investing is less about the size of the starting amount and more about consistency over time. Small amounts invested regularly can grow gradually and build meaningful results in the long run. Starting with smaller amounts also removes pressure. It allows people to learn how investing works without feeling stressed or overwhelmed. This approach helps build confidence and discipline, which are far more important than a large one-time investment. Investing is not a race. It is a long-term process that rewards patience and steady effort. When people focus only on needing more money, they often miss valuable time that could be working in their favor. The key is to invest money that can remain invested for the long term. Investing money that might be needed soon can create stress and lead to rushed decisions. This myth creates unnecessary fear and causes people to wait for the perfect moment that may never arrive. The truth is that investing is accessible to many people, regardless of income level, when approached thoughtfully. Investing is not about starting big or being rich. It is about starting where you are, building a habit, and staying consistent over time. When consistency is combined with patience, even modest beginnings can support long-term financial growth. 3. Investing means you will lose all your money. Fear of losing money is one of the strongest reasons people avoid investing altogether. This fear often comes from dramatic stories, market crashes, or headlines that focus only on losses. While it is true that investing involves risk, that does not mean losing everything is guaranteed. Markets naturally move up and down, and these movements are a normal part of how investing works. Short-term drops can feel uncomfortable, but they do not represent the full picture. Investing is built for long-term growth, not instant results. Over longer periods, markets have time to recover from downturns and continue growing. The myth that investing automatically leads to total loss ignores this long-term perspective. Risk exists, but it is not random or uncontrollable. It can be managed by choosing investments that match personal comfort levels, financial goals, and time horizons. Not every investment carries the same level of risk, and thoughtful choices can help reduce unnecessary exposure. Avoiding investing entirely also comes with risk, even though it may feel safer. Money that remains unused or sits still for long periods can slowly lose purchasing power due to rising costs of living. This hidden risk is often overlooked because it happens quietly. While investing does not promise guaranteed gains, it offers a way for money to grow and keep pace with the future. This myth exaggerates fear and focuses attention only on worst-case outcomes. It hides the role of patience, discipline, and long-term thinking in successful investing. Understanding that risk and growth are connected helps create a more balanced view. When fear is replaced with knowledge, investing feels less intimidating and more manageable. For investing is too expensive because of fees. Many people believe investing is not worth starting because fees will slowly take away all the profits. This belief makes investing feel unfair and discouraging, especially for beginners. While it is true that fees exist, they are not always high, hidden, or unreasonable. In fact, many modern investing options are designed to be transparent, clearly showing what you are paying and how those costs are calculated. This helps investors understand exactly where their money is going. Fees usually cover important things like fund management, administration, and access to diversified investments. These services help structure investments and manage them over time. The real issue is not the presence of fees, but the lack of understanding around them. When people do not know what they are paying for, fees feel intimidating and confusing. This often leads to fear-based decisions instead of informed ones. Assuming that all investing is expensive causes many people to avoid investing entirely, even when affordable options exist. This myth keeps people on the sidelines instead of encouraging them to learn how different investment products work. In reality, understanding fees is part of becoming a confident investor. When costs are clear and reasonable, investing becomes much easier to evaluate and compare. Awareness helps replace fear with clarity. Learning how fees work allows people to focus on long-term growth instead of worrying about myths that don't reflect how investing actually works. 5. You must get financial advice before investing. Many people believe they cannot start investing unless they first speak to a financial advisor. This idea makes investing feel complicated and out of reach, especially for beginners. Financial advice can be useful, particularly when someone has a complex money situation or many financial responsibilities. However, that does not mean advice is required before taking the first step. Investing can begin in simple ways that are designed to be easy to understand and suitable for long-term goals. This myth often causes people to delay investing for years while they wait for the right time or the right expert. During that time, money sits still instead of working toward future growth. Learning the basic principles of investing, such as time, risk, and diversification, can give beginners enough clarity to start with confidence. Many investing options are built specifically to reduce complexity and remove the need for constant decision-making. Believing that professional advice is mandatory makes investing seem harder than it truly is. It creates unnecessary pressure and fear of making mistakes. While advice can certainly add value later, especially as finances grow or become more detailed, it does not have to be the first step. Confidence in investing grows through understanding, patience, and experience. Starting small and learning over time often builds more confidence than waiting indefinitely for perfect guidance. There you have it. 5 common investing myths that create confusion and unnecessary fear. Once these myths are removed, investing becomes much easier to understand and far less intimidating. It is not about being perfect or knowing everything. It is about clarity, patience, and long-term thinking. When you focus on facts instead of rumors, investing starts to feel more realistic and manageable. If this video helped you, hit the like button to support the channel. Share it with someone who feels unsure or hesitant about investing. And subscribe for more simple, honest videos that explain money topics clearly and help you build better financial habits over time. Thanks for watching. I'll see you in the next video.